Welcome to Subramani. This video is something which is meant for almost anybody, but I'm more aimed at the person who's managing other people's money than at the retail individual investor. So the first thing is I'm going to talk about how to get yourself and your clients to think about long term. So first of all, when you are sitting with the client and you have done your goal setting and objectives, etc., you have to understand that when you are investing in equity, you have to have a long term orientation. Now when you have long term orientation, if somebody comes to me, the long term orientation have to be a few things like I should not lose money, right? I should earn greater returns than the in real terms. I should earn 1 or 2%, so that the money that I invest gets really built towards my long-term goals. Could be children's education, could be own retirement, could be anything, but long-term goal, which means 10 years, 15 years plus. So goal orientation has to be long-term. So I'm going to talk about a lot of things, but first of all, let us talk about long term. When you have a very clear mandate from the client, and make sure that you're talking to your customer on a regular basis, keep asking, is there any short term goal? Is there any foreign trip that you're planning for which you're going to remove money from equities? Anything, anything like that. If the answer is no, if the client says no, I have enough salary, I have enough cash flow from my business or from my practice, which means the orientation is very clearly long term, because only the long term money, which is 10 years, 15 years, should be in equities. No point in having 1 year money and 2 year money in equities. Secondly, explain to the client that when you have a long term orientation, for example, if I put money in a pension fund, which is 70% debt and 30% equity or something like that, and I can't compare it to a 1 year return and 3 year return on a equity fund. It will not match. The purpose is not to match. The purpose is to say this fund of mine will do well over a 10 year period or a 15 year period, because 30% equity is good enough and 70% debt is going to add towards the stability. Yes, of course, if interest rates go up, this portfolio will fall. The 70% of the portfolio will fall, but the 30% hopefully will make up, right? So you have to have very clear that you and your client and your employees, everybody think in terms of long term. So you're not perturbed that you're underperforming in the short term, like 1 year performance is bad, 3 year performance is bad. Don't bother too much. Yes, of course, you can look at rolling return after it is 3-4 years. All that is fine, but don't bother too much about that. In fact, I would think don't even calculate that. Yes, of course, if you've kept all these data in some nice software, you will know what is you will know what is the return. That's not a problem, but don't concentrate on that. Don't talk about that at all, because then the long term orientation is gone. So very clearly you are oriented towards the long term. So keep doing that. Keep investing for the long term. Keep doing your SIP, because you are clear. Like even today, let's say the market is at 60,500 or 61,000, and you have two clients. One is a 45-year-old salaried employee earning about 1.5 crore or 1 crore plus, and he's got some 1 crore profit also in his equity portfolio. Please remember, it is just 1 year's salary, right? So for him, or you change the figure to 10 lakhs of profit and 10 lakhs of annual income, doesn't matter. Principally, it just means 1 year income is there in profits. It's not too much. If it is 5 or 6 times his annual income, then it is different. Like even if the market were to correct totally and he would lose everything of that he has in terms of profits, he will still have the, let's say, 3 crores what he has invested. He will have that as it is. He would have lost just 1 crore, which is just 1 year's effort, right? So it's not a very big amount, right? I'm ignoring taxes for example now, but that is what is at stake. So don't touch that money unless that person says, okay, I agree, I have put 3 crores, it has become 4 crores, or I put 2 crores, it has become 3 crores. Out of this profit which I can see, I want to take some money out and go on a trip to Europe. then that is clarity. Therefore you're removing money because you want to take some money off the table from equity and do something. That's perfectly all right. But if you have no such need, there is maybe no need to sell some or redeem something like that, right? So first of all, that is have the long-term orientation, because when you don't have long-term orientation, you get confused and then you look at it on hourly basis and minutely basis, right? So that's not the purpose. It has to be very clear for you and for your investor. And if you're a direct investor and who is coming here, then again, this is for you. Have that orientation, because if you don't have that orientation, you will also feel, oh, I should have invested in that fund, I should have invested in this fund. Last 6 months that fund has done well. Doesn't matter. So be very clear that if a person does not need the money, that money has to remain in equity. Partial booking of profits not necessary at all, unless you want to spend that money. If you don't want to spend that money, don't withdraw. Let it lie in equity, right? Then stick to your, every client of yours will have a completely different attitude towards money, right? But you stick to your knitting and say, okay, this portion of yours, let's say there is a husband and wife. Husband has 2-3 crores, all the money kept in bank deposits, etc. He's very scared of putting the money in equity. That's fine. The wife's money you are managing, and she's earning about 1 crore and a half per year, and you have put about 1 crore of hers over last 3-4 years into equity funds, and that has also increased in value. So she's sitting on profits of 1 crore. Is it necessary that she should book some profits and put that money in debt? Answer is no, because overall, as the family goes, the husband has anyway invested in debt instruments, the wife is investing in equity. So let the wife's money remain in equity. There is absolutely no reason at all for her to change her asset allocation, because as a family they're fine. So stick to your portfolio allocation, saying, okay, she is a equity investor and he is a debt investor, which is perfect. Or it could be completely different. She could be the debt investor, he could be the equity investor. So look at the overall portfolio in which they have invested. Next is, when the client asks for something, don't have to answer immediately. Let me put it this way. It may sound very negative. I'm not meaning it in a negative way. I'm meaning it in a positive way. If the client says, should we do asset reallocation, don't answer it immediately. Say, I will apply my mind, because each client is very different. Then go have a look at the portfolios. Maybe you want to shift from one fund house to another. You don't want to take too much risk of being in one fund house. You may not want to take the risk of being too much in one country. You may not want to take a risk of being too much in debt or too much in equity, right? So don't immediately say, no, you don't need any asset allocation. Go and check. Maybe some money should go into US funds, something should go into Japan funds, right? So you are there, you are the boss. Sit with the client, understand what the client says when you need to reallocate. So do that, and do that patiently. So take time. First of all, don't react immediately, just wait. Because if you have made up your mind that the client does not need a reallocation, you will not be able to see it. So after some time, have a cool look at it. Then explain to the client why an reallocation is necessary or why it is not necessary. So slowing down the decision making can be very nice for both of you. You won't act in a hurry, and it's not necessary to act in a hurry. Then keep on reframing the question towards your objectives. This is towards your children going abroad to study, right? So each child is going to require 2.5 to 3 crores about 5 years from now, right? Or 4 years from now. So keep reframing and make the clients understand the objective for which they are investing. It could just be retirement. It could be children's education. It could be grandchildren's education. It could be anything, but keep reframing, because clients sometimes lose objectives. Lose the objective for what they are investing. So if it's your money and you are investing for yourself, please understand why you are investing. Because if the goal is lost, then all this regret will be, oh, I wish I had sold, I had bought, and all that. No, it doesn't happen that way. When the objective is very clear and you're seeing the objective, you cannot see the obstacles in between. That's fine. That's the purpose. Go towards your objective. Objective is my granddaughter's education. She's now 11 years old. When I want to have this money when she's 21. So I got a 10-year time frame. 10 years not too great, but at least there is clarity that this is 10-year time frame. Meanwhile, if the child does not want to go abroad, you may not need the money. That's a different thing. But that goal orientation, saying why I need the money, what is the goal, what is the time frame, is necessary. Another thing very important is engage with the client regularly. Make sure that the client understands the objectives for which they have been investing. Engage with the client. I've said this many times. And then also understand that if you are an organization, how you reward your investment advisors and how do you reward your fund managers has to be rewarding them on the process and not just the end result. Because if the market anyway booms, then every research analyst and every fund manager is going to look smart. Also ask your fund managers and research people to give slightly not very clear targets. It's very difficult to say, oh, today the price is 80, it is going to reach 124, 134. It's very difficult. Don't expect such targets and don't reward these targets. If you start rewarding targets, everybody will start guessing. It makes no sense. So ask for a range of prices, ask for what is the logic, why it is happening. So start rewarding the process and not the outcomes, because it is easy to reward the outcomes and claim credit. See, I knew it will reach 124. How did you know? Why did it happen? Why did you fail? Right? Analyzing failures is very important when you're talking to research analysts and investment advisors. Why you failed? What happened? Why did we not reach the target? Right? Those kind of things. Also see on what basis, from where they are collecting data, what they are doing, right? So from where is your financial advisor getting the data? What is he or she doing with the data? Are they short term in their thinking? So if you are an investment advisor, find out whether you are a short term thinker. Do you call the client and say, look, this year return is 24%, I got you 24%, you did not, the market got. The more important milestones are, has the client reached any particular milestone? Has his investment profit become 2 crores? Has his investment profit become 3 crores? That is what you're looking at, saying, okay, this is what you had invested, this is what it has become. Don't get into individual performance of funds. Some US fund has given 24% and some Japanese fund has given 10%. Maybe it's a great time to remove money from US and put it in Japan. I'm just giving you examples. I'm not saying you should be doing this. So doing that and set up the formal processes for collecting information, collecting data, seeing why this is happening. And I don't see what kind of a performance appraisal can you do for a fund. You pick up a fund, you see the fund manager, it has not changed, his orientation has not changed, he has not said anything different, and you then look at his portfolio, whether the investment objectives and the portfolio match. Once that is there, you really don't have too much to do as an individual financial advisor or a RFD. There's very little that there is really very little that you can do in terms of, you can't really pick up the phone and talk to a fund manager and say, why did you buy this? You should have sold this, or things like that. You really can't. So what kind of a performance appraisal are you going to do? See whether it is keeping in objective, your objectives are met by that fund. If that is not being met by that fund for whatever reasons, you want to take more risk, you want to take less risk, whatever it is, you want to go from a large portfolio to a concentrated portfolio. So here is a fund which has got 80 companies in its large cap fund, and there's another fund house which has got 25 companies in its large cap fund. You may want to go from a longish portfolio to a shortish portfolio. Perfectly all right. Or it could be the reverse. You may want to say, okay, let me reduce risk, let me go to that fund manager. Unfortunately, these all have the tax implication of dividend distribution tax, of STT and of income tax. Unfortunately, there is long-term capital gain even when you shift from one fund to another, unlike in real estate. But well, also start rewarding the fund managers. If you are a fund house, start rewarding the fund managers on more sustained basis rather than on a monthly basis or a yearly basis, right? So 2-year performance, 3-year performance, and that you compare it to comparable funds and to the index, and if he has got that achieved, then the purpose is being achieved. The end investor has to understand that this fund manager should be assessed on a 3-4 year basis and not on the calendar basis, on a yearly basis, right? That does not make sense. So incentives have to be more long term oriented and less short term oriented. Even when you are creating a team, make sure that everybody thinks in terms of long term portfolio, which means their personal portfolio should not have any trading activity at all, right? So whether their spouse, whether their brothers and all do, brother, sister, son, daughter do, is not your business, but this person whom you employ should have a long term orientation. So then sit with your team and see what are the behavioral flaws that can happen, right? So whether you sit with your client and see what are the behavioral flaws that are happening, saying, oh, I'm now getting very election oriented, am I doing that, am I worried that in 2024 what will happen, and in 2022 will BJP win in UP, right? Do those things bother me? It should not bother you if you're a long-term investor. If you're a short-term trader, you should be worried. If you're a long-term investor, it doesn't matter. UP will get some chief minister, right? And some things will happen. So don't worry too much about all those things. Don't let those don't let all that noise disturb you, because very clearly you are here for the long term and you are investing for the long term. So this is some attempt made, and keep away from the media assessing your portfolio on a regular basis. And also don't listen to too much of what the CXOs are talking. Please also understand that it is not in the interest of the media houses to tell you, oh, put money in an index fund and go to sleep. Then you will not come back for 30 years. So they have to tell you, oh, Larsen & Toubro is 1842, you should buy it. And then tell you, oh, see, we asked you to buy at 1842, now it is 1912, this is fantastic profit, you should book your profit. Just forget that when the media guy is talking, he's not talking about transaction costs. Does not know, they don't understand about capital gains, they don't understand about taxation, they don't understand anything. They just tell you, "Arey, 2 rupees profit ho raha hai, bech do." That is exactly how the media guy and your RM will talk. You have to understand that you should not listen to them if you are clearly long term oriented, because there is a conflict in the media and in your RM to say just sit tight and you will make money. I have made money sitting tight over longish periods of time. A lot of my portfolio was bought in the 1980s when I just started earning. I've just added on to that as and I have more money. So portfolio sizing, that is what I have done, rather than increase the number of shares in the portfolio. Thank you.